Hi everyone, and welcome to SIC Forex. I hope everyone is having a successful trading week. Feel free to like, comment, and subscribe. In this video, we'll take a look at some Forex basics to help you advance as a trader. Today we'll be discussing what is a pip in Forex, what is a lot size in Forex, leverage, and margin trading. When looking at the market watch on your MetaTrader, you will notice that the price of various currencies tends to jump up and down. This is called fluctuation. These movements in the Forex market are measured in pips. What is a pip in Forex? A pip is the smallest price movement of a currency pair. 1 pip is the 4th decimal place, or the red number in our example. If the Euro USD rises from 1.15300 to 1.15382, in trading terms it means 8.2 pips movement upwards. Any pip of any currency is translated into money and automatically calculated by your MetaTrader. The trader's life has become really simple. There is no need to do the calculation by yourself. You just need to fit them into your wishes and expectations. It is very important to know if a pair includes the Japanese yen, then the quotation currency goes 2 decimal places out to the left. If the pair USD yen moved from 106.84 to 106.94, we say that the pair went up 10 pips. Some trading platforms present quotations showing 5 decimals as in our example. In these cases, the 5th decimal is called a pipette, which is a fractional pip. Let's take the Euro USD. The 5th decimal is worth 2/10 of a pip, or 2 points. Profits and losses are not only calculated in money terms, but also in the language of pips. It is important to understand this language of pips, and next we'll combine this information with lot sizing. What is a lot in Forex? Forex is commonly traded in a specific amount called lots, or simply the number of currency unit you will be buying or selling. This means a lot is a unit of measuring a transaction amount. When you place orders on your trading platforms, orders are placed in size quoted in lots. The standard lot size is 100,000 units of currency. And then there's also mini, micro, and nano lot sizes, which are 10,000, 1,000, and 100 units. As we've already discussed, the change in a currency's value relative to another is measured in pips, which is a very, very small percentage of a unit's currency value. To take advantage of these small movements in price, you need to trade large amounts of a particular currency in order to see any significant profit or loss. You are probably wondering how a small Forex trader can trade such large amounts of money. That is where leverage comes in. Firstly, what is leverage in Forex? Leverage is the degree of credit you wish to get from your broker on your deposit when opening a trade. Think of your broker as a bank that basically fronts you $100,000 to buy currencies. All the bank asks is that you give $1,000 as a good faith deposit, which it will hold for you but not necessarily keep. In simple terms, for every $1 deposited, your broker will borrow you $100. or a 1 to 100 leverage. The amount of leverage you will use depends on your broker and what you feel comfortable with. For each transaction, you'll need a specific amount of deposit for that position. In other words, the broker will require minimum security for each trade, also known as margin. Let's look at an example. If the allowed leverage is 1 to 100, or 1% of the position required, and you wanted to trade a position worth 100,000, but you only have 5,000 in your account, no problem, as your broker would set aside $1,000 as a deposit and let you borrow the rest. The $1,000 is not a fee, it is a deposit. You get it back when you close your trade. Of course, any gains or losses will be deducted or added to the remaining cash balance in your account. You have a wide degree of leverage available to choose from. However, when you are starting out, I recommend using a low leverage and then increasing your leverage as you become more comfortable with trading. The main task of leverage is to multiply your trading potential, as now with a small deposit, you are able to trade large lot sizes with your account. Understanding how margin trading and leverage works is so important that I have dedicated a whole video to it later in the course. It is a must watch if you don't want to blow up your account. In our next video, we'll be taking a look at the different ways that traders analyze the market to determine whether to buy or sell a specific currency pair. In other words, we'll be taking a look not only at the different types of analysis, fundamental, technical, and sentiment analysis, but how these affect your decision making as a Forex trader. If you haven't already, please like, comment, and subscribe. Thank you for watching. Happy trading. Bye.